Hello everyone, welcome back to Dividends and Beyond, your go-to channel for all things dividend investing. I'm JT, and today we're going to talk about how to pick the best dividend stocks for your portfolio. If you're new here, make sure to check out our previous videos to get up to speed. Let's get started. Before you buy into any dividend stocks, it's important to know how to evaluate them. These metrics can help you understand how much in dividend to expect, how reliable a dividend might be, and most importantly, how to identify red flags. Dividend yield. This is the annualized dividend represented as a percentage of the stock price. For instance, if a company pays $1 in annualized dividends and the stock costs $20 per share, then the dividend yield would be 5%. The yield is useful as a valuation metric when you compare a stock's current yield to its historical level. All other things being equal, a higher dividend yield is better, but a company's ability to maintain the dividend payout and ideally increase it matters even more. Dividend payout ratio. This is the dividend as a percentage of a company's earnings. If a company earns $1 per share in net income and pays a 50-cent per share dividend, then the payout ratio is 50%. In general terms, the lower the payout ratio, the more sustainable a dividend. Cash dividend payout ratio. This is the dividend as a percentage of a company's operating cash flows minus capital expenditures or free cash flow. Total return. This is the increase in stock price, known as capital gains, plus dividends paid. For example, if you pay $10 for a stock that increases in value by $1 and pays a 50-cent dividend, then the $1.5 you gain is equivalent to a 15% total return. Earnings per share, or EPS. The EPS metric normalizes a company's earning to the per share value. The best dividend stocks are companies that have shown the ability to regularly increase earnings per share over time and thus raise their dividend. PE ratio. The price to earnings ratio is calculated by dividing a company's share price by its earning per share. The PE ratio is a metric that can be used along with dividend yield to determine if a dividend stock is fairly valued. Picking the right dividend stocks is really important. Here are 6 simple tips to help you find good dividend-paying stocks. First, don't just go for high dividend yields. A high yield might look good, but there could be a reason for it. If a stock price is going down, the yield might be high, but that's a bad sign. It could mean trouble ahead. Check why the yield is high before you invest. Next, look at payout ratio. This tells you how much of the company's earnings are going to dividends. If it's over 100%, the company is paying more than its earning, which isn't sustainable. If the company is losing money but still paying dividends, you might want to rethink investing in it. Check the company balance sheet. High debt levels can be a problem because the company needs to pay debts before dividends. Look for companies that grow their dividends. Companies that increase their dividends regularly tend to do better over time. This shows they are financially healthy and committed to giving back to shareholders. Different sectors have different risks. For example, banking, consumer staples, and utilities have steady dividends but less growth. Tech companies might offer more growth but can be more volatile. Choose sectors that match your risk tolerance. Also be mindful of big trends that affect sectors. If you are looking for an easy solution to investing, exchange-traded funds or ETFs can be an excellent choice. ETF typically offer a diversified allocation to whatever you're investing in, either stocks, bonds, or both. These funds hold many dividend-paying stocks, giving you more diversification. Are dividend payments taxed? Yes, dividends are taxed. Dividends are either qualified or non-qualified. Qualified dividends are taxed at capital gains rate, which is lower than ordinary income tax rates. Non-qualified dividends are taxed as ordinary income. Think about your tax bracket when choosing dividend stocks. If you are in a higher tax bracket, prioritize stocks with qualified dividends for tax savings. Non-US residents don't have to pay US capital gains tax, and the brokerage won't withhold money for it. This doesn't mean that you can trade tax-free. You will likely have to pay capital gains tax in your country. You have to pay a 30% tax on dividends from US companies. But you don't pay the tax on dividends from foreign companies or on certain types of interest or short-term capital gain dividends. Now, a quick update on my portfolio. I'm in my second month and I have invested $1,500. I focus on stocks that pay dividends and have growth potential. My portfolio includes Microsoft, Google, Apple, Visa, AbbVie, Coca-Cola, Procter & Gamble, United Health Group, Realty Income, Vichy Properties, and McDonald's. I also bought ETFs, namely VOO and SCHD. Remember, not all dividend strategies are the same. High-yield stocks give large dividends but may not grow much. Dividend growth stocks have smaller yields initially but increase over time. Sector diversification is key to managing risk. Thank you for watching. Don't forget to subscribe and click the notification bell so you never miss an update. Welcome to the Dividends and Beyond community. Remember, dividend investing isn't just about earning money. It's about securing your financial future. See you in the next video. Bye!